Donald Trump has once again shaken the American financial markets, this time by openly attacking the Federal Reserve and its chairman, Jerome Powell. The reason? He's demanding an immediate cut in the key interest rate, despite ongoing inflation and growing concerns from analysts. In a scathing statement, Trump called Powell an enemy of growth and labeled the Fed's actions as sabotage of the American economy. Following his remarks, the Dow Jones and S&P indexes tumbled sharply while investors rushed to gold and Bitcoin as safe havens. But is it really that simple? What's behind this bold ultimatum? Why could this clash between the White House and the Fed not only shake the market but trigger a domino effect across the global economy? Today, we'll break down who truly controls interest rates in the US, what Trump's pressure could mean for the Fed, and the possible consequences for every investor. Before finding that out, if you are liking this video, don't forget to like, share, and subscribe. Share your thoughts in the comments section and let your voice be heard. Now moving on. The Federal Reserve System is the central bank of the United States. It's responsible for regulating the money supply, setting interest rates, and ensuring price stability. The Fed's most important value? Its independence from politicians. Decisions on rates are not made by the president, but by a committee of economists, led by the chairman, currently Jerome Powell. But Donald Trump has long made his discontent clear. As early as 2018, when he first appointed Powell, their relationship started to fray. In his speeches, Trump accused the Fed chair of killing American growth and misunderstanding the markets. In 2020, amid the pandemic, he practically tried to force the Fed's hand, demanding that rates be cut to zero. Now, in 2025, history repeats itself, but in an even more aggressive form. As the economy slows and the elections approach, Trump is once again calling for an immediate rate cut, claiming that Powell is suffocating the economy and preventing Americans from breathing freely. The irony? Inflation in the US is still elevated, and many analysts warn cutting rates too soon could spark a second wave of inflation, especially with rising energy prices and escalating global geopolitical risks. Financial markets reacted instantly. Within a day, the Dow Jones Index dropped over 1,000 points, and 10-year bond yields spiked sharply. Investors rushed out of the dollar and into safe havens: gold, the Swiss franc, and Bitcoin. Economists are deeply concerned. If the Fed bows to political pressure, it would set a historic precedent. Trust in an institution that has underpinned global financial stability for decades could be irreparably damaged. Trump's pressure on the Fed is not just a news headline. It's a move that could radically reshape the global financial landscape. Let's start with the key question. What happens if the Fed actually cuts rates under pressure from the White House? In the short term, markets might cheer. Cheaper credit means more business activity, a rising stock market, and better corporate earnings. And that's exactly what Trump wants ahead of the elections, to create the illusion of explosive growth. But here's the problem. Interest rates aren't just a growth lever. They're a primary tool to fight inflation. And right now, inflation is still above the target level. If rates are cut prematurely, it could trigger an explosion in consumer prices, inflation, a new mortgage and credit frenzy, asset overvaluation, and dangerous bubbles in stocks and crypto. Investors would be especially vulnerable. Simply put, when rates drop, bond yields fall, people flee to riskier assets. And when something goes wrong, mass panic and sell-offs begin. Meanwhile, the dollar weakens, accelerating capital outflows from the US. We're already seeing it. Some central banks are diversifying reserves, buying more gold, and cutting exposure to US treasuries. For everyday Americans, the effects are felt through rising prices for food, energy, and housing, more expensive imported goods, a decline in purchasing power. And what about businesses? Sure, at first they'll feel relief, cheaper loans, more cash flow, but if inflation returns after rate cuts, the cost of raw materials and logistics will surge, eating away profits again. The stock market in this scenario becomes wildly unpredictable. It'll start with optimism-fueled gains. But once the market senses that the Fed is no longer protecting stability, the exodus begins. Tech stocks and high-risk startups will suffer the most. Cryptocurrencies and gold, on the other hand, will become safe havens. It's no coincidence that gold has already broken all-time highs, and Bitcoin is racing toward $90,000. When confidence in the dollar and the Fed wavers, alternative assets catch a second wind. The bottom line? Pressuring the Fed is like shaking the foundation of a building just to finish the roof faster. You might achieve short-term growth, but the whole structure becomes unstable. One external shock, and everything crashes. That's why investors, economists, and even international institutions are sounding the alarm. Trump's pressure on the Fed is not just an internal threat to the US, it's a red alert for the entire global economy. The International Monetary Fund, IMF, in its latest report, explicitly stated that the actions of the US administration are destabilizing the global monetary system. IMF Chief Kristalina Georgieva declared, "Politicizing central banks undermines investor confidence and could lead to systemic failures across international capital markets." Europe has its own concerns. European Central Bank President Christine Lagarde publicly criticized the White House's actions, calling them an attack on regulatory independence and a direct threat to global dollar stability. Amid rising tensions, hedge funds in London, Tokyo, and Singapore are rapidly moving into safe haven assets. Central banks in Switzerland, Norway, and Saudi Arabia are increasing the share of gold in their reserves. But the most intriguing response comes from emerging economies, long committed to de-dollarization. China is expanding settlements in yuan and actively promoting the idea of an alternative reserve currency within BRICS. Russia and India are signing oil and coal contracts outside the dollar system. Brazil has struck a trade deal with the EU using the euro for settlements. All of this stems from one simple conclusion. If the US loses control over its own central bank, the world loses trust in the dollar. Now let's imagine what comes next. China dramatically reduces its investment in US treasuries. Saudi Arabia switches oil contracts to the yuan. The ECB starts positioning the euro as a new reserve asset. This isn't some distant future scenario. These are processes already in motion. The world is watching closely to see who gains the upper hand, Trump or Powell. And if political pressure wins, it could mark the beginning of the end for the dollar's reign as the world's sole reserve currency. You'd think there's nothing more serious than a public clash between the president and the Fed chair. But behind the scenes, the picture is even more alarming. According to leaks from within the Republican Party, Trump is already considering a full replacement of Jerome Powell, and not after the elections, but before the end of summer. One of the leading candidates reportedly being considered, Larry Kudlow, Trump's former economic advisor and a known advocate for soft monetary policy. If this happens, the Fed would no longer be an independent financial authority. It would become a purely political tool. We cannot allow Powell to keep destroying America. We need someone who listens to the people, not Wall Street. A quote from Trump's private speech to donors in Palm Beach. This isn't just rhetoric, it's a direct threat to institutional stability. In the entire history of the Federal Reserve, no president has ever attacked its chairman so openly. And investors, they're already pricing in the risks. 10-year Treasury yields jumped from 3.98% to 4.35% in just 3 days. A massive surge and a clear signal of doubt in the long-term stability of the US economy. But the most alarming detail comes from a leaked IMF report. If political interference in the Fed's operations continues, the US could lose its status as a trusted borrower within 2 years. And now, pay attention. Trump is reportedly discussing with his legal team the creation of a parallel economic decision-making council, a body that would be directly controlled by the administration. This is essentially an attempt to bypass the Fed and build an alternative center of economic power. It sounds almost like science fiction, but in a world where gold is smashing records and trust in the dollar is crumbling, this scenario can no longer be ruled out. The conflict between Donald Trump and the Federal Reserve isn't just political drama. It's a full-blown stress test for the entire financial architecture of the United States. If the Fed bows down, the consequences will be felt not just on Wall Street, but by every investor, every business, and every individual with a mortgage or savings. This is one of those moments when everything feels like it's coming apart. But it's exactly in times like these that fortunes are forged and illusions are shattered. Now let me ask you, should the Fed chair obey the president? Or is central bank independence sacred? Drop your thoughts in the comments. I read every single one. And if you care about what's happening with your money, the markets, and the future, subscribe to BULLZ Capital. Here, we speak the truth. No fluff, just facts. Check out our other videos.